39 million ounces just disappeared from the system in under 2 months vanished. This isn't a market fluctuation. This is a fundamental fracture. The largest strategic vaults on Earth are bleeding metal, and powerful institutions are suddenly refusing to sell. If you understand the historical pattern unfolding right now, you'll see why the next 12 months change everything. In February 2025, a group of major international banks made an unprecedented, coordinated move. They halted all sales of physical silver. Not a temporary pause, not a supply hiccup, an indefinite suspension. This follows similar moves by other major nations to block citizen access or control export flows. The message from the inside is deafeningly clear. Physical inventory is being guarded at all costs. But why? To understand, you need to see the four-act play that has governed every single monetary collapse in history. And by the end of this video, you'll know precisely which act we're in right now. Why this time the pressure is irreversible, and the critical mistake almost everyone makes when the break finally comes. Let's define the pattern. It's brutally consistent. Act 1. Foundation. A tangible asset is universally accepted as real money. It backs currencies, circulates in coins, and provides bedrock trust. For America, silver was money in every pocket until 1965. Act 2. Substitution. The system realizes it's more profitable to create paper promises against the physical asset. 1 real ounce suddenly has 50. Then 100 paper claims trading against it. The price is suppressed because the market is flooded with digital ghosts of real metal. Supply appears infinite, but it's a mirage. Act 3. The reckoning. Real demand, both industrial and monetary, collides with the paper fantasy. Entities start demanding actual delivery. Vaults begin to empty. The terrifying gap between paper promises and physical reality becomes undeniable. This is the bank run phase. Act 4. The rupture. The paper market shatters. Trading halts. Delivery failures snowball. The price for the real, physical asset detaches completely from the broken paper price and goes vertical. Those holding the tangible asset preserve wealth. Those holding paper promises are left with worthless digital entries. This cycle isn't theoretical, it's a historical certainty. And the data proves we are deep into Act 3. But first, you must grasp why silver is the ultimate pressure point. Gold is financial armor. Silver is that, plus the indispensable bloodstream of modern technology. Your smartphone, every solar panel, every electric vehicle, every advanced medical device, they all depend on silver. We are in a structural deficit, consuming more than we mine for the 4th consecutive year. Industrial demand is on a one-way trajectory up, while mine supply is stagnant or falling. This isn't speculation. It's physics and economics on a collision course. Now, let's apply the pattern with a historical case study that mirrors today perfectly. The late 1970s, rampant inflation. 2 billionaire investors, the Hunt brothers, saw the writing on the wall for the dollar. They began an enormous accumulation of silver. They didn't just buy paper contracts. They took massive physical delivery, draining exchange vaults. Their thesis was correct. The price soared over 700% in a year. But then, the system that created the paper market changed the rules to protect itself. The exchange banned new buyers and raised margin requirements impossibly high overnight. The Hunts, over-leveraged in paper, were forced to sell. The price crashed on Silver Thursday. But here's the pivotal lesson everyone misses. Those who held physical metal, not paper, never lost. When the dust settled, the price was still multiples higher than where it started. The system can change the rules of a paper game, but it can't confiscate what you truly own. That exact lesson is paramount today because the setup is identical, but the scale is global. This isn't to speculators. This is entire nations, industries, and millions of awakening investors. Let's look at the real-time data confirming Act 3. registered silver metal actually available for delivery in the world's key exchange vaults has been plummeting, from over 80 million ounces to just over 40 million in a matter of weeks. That's a near 50% drain. This is inventory being pulled, not traded. Simultaneously, we see a market anomaly screaming shortage, backwardation. The price for silver right now is higher than the price for silver promised in the future. Normally, you pay a premium for future delivery to cover storage and time. When you pay a premium to get it today, it means the market is desperate for immediate physical metal. The paper price is becoming a fiction. Banks halting sales, nations restricting exports, vaults draining, backwardation flashing red. This is the coordinated tremor before the earthquake. So, what triggers Act 4, the rupture? A catalyst. A major delivery failure on an exchange. A sovereign nation making a massive physical purchase. A mainstream admission of the supply deficit. When it hits, the paper market will freeze. Premiums for physical metal will detach from the reported spot price. You'll see headlines of trading halts for cooling issues or settlement delays. Then, the scramble will be for any form of real metal at any price. Given this pattern, what should you do? Your strategy must be built on one principle: removing counterparty risk. First, differentiate between speculating and protecting. Trading paper, SLV, or futures is a bet on price movement within a broken system. Owning physical silver is insurance against the system itself. Second, acquire physical metal you can hold. Coins and bars from recognized sovereign mints. Store them securely under your control. The goal is to have an asset with no one else's liability attached. Third act, while the window is still marginally open, premiums over the spot price are still relatively low. When Act 4 accelerates, those premiums will explode and then availability will vanish. You won't be competing with traders. You'll be competing with governments and Fortune 500 companies for the remaining crumbs. Fourth, allocate wisely. This isn't about betting the farm. It's about a strategic allocation of your wealth into a tangible, non-digital asset that has served as money for millennia. The clock is not measured in years. It's measured in vault withdrawals and policy announcements. The pattern is complete. The actors are on stage. The outcome for those who recognize the play is inevitable. When the digital promise breaks, the physical truth remains. If this logic resonates with you, your next step is critical. Please support this channel by hitting the like button. It helps more people see through the noise. For deeper insights into building resilient wealth, subscribe to Winds of Thought. In our next video, we'll deconstruct the parallel collapse unfolding in the commercial real estate debt market, another domino in the same sequence. The patterns are everywhere, once you know how to look. Subscribe and turn on notifications so you don't miss it. The time for passive observation is over.